What if the world's most powerful bank just declared war on Bitcoin's biggest public supporter? What if the same institution that once called Bitcoin a fraud is now being accused of weaponizing its own rules to force the sale of MicroStrategy stock in a move that feels less like business and more like a direct assault? This isn't just a story about stock prices or arcane financial rules. This is a story about a battle for the future of money. On one side, you've got JP Morgan, the titan of traditional finance, the gatekeeper of the old system. On the other, you have MicroStrategy, a company that has bet its entire future on Bitcoin, led by the unapologetic digital asset evangelist Michael Saylor. For weeks, the crypto community has been buzzing with accusations of a coordinated multi-front attack designed to cripple MicroStrategy and cast a dark shadow over the entire Bitcoin world. They're saying this isn't just market noise, this is manipulation, this is a targeted strike. So, is this just business as usual? A bank simply managing its risk? Or is it a calculated attack by the legacy system to undermine one of its greatest perceived threats? We're about to break down the evidence piece by piece. We'll look at the reports, the market data, the community outrage, and the official responses. And by the end of this, you can be the judge. It all started with a sudden, sharp, and seemingly random drop in the price of both MicroStrategy stock and Bitcoin. One minute, the market's doing its thing. The next, a wave of red candles sweeps across the charts, leaving everyone bewildered. There was no obvious economic news, no major global event to explain it. It felt, as many in the community put it, manufactured. The confusion didn't last. Whispers grew into a roar as analysts and crypto media started connecting the dots, pointing to a series of events that, when you line them up, paint a pretty unsettling picture. The story that emerged wasn't one of random market chance, but of a sophisticated, multi-pronged assault. And at the center of it all, JP Morgan Chase. The first clue, according to trading firm Empery Digital, was a quiet but devastating change made months earlier. The firm alleged that JP Morgan had discreetly raised the margin and collateral requirements for clients holding MicroStrategy stock way back on July 7th. While this went mostly unnoticed at the time, its effects were like a hidden tripwire, just waiting to be triggered. Then things escalated. The real chaos began when reports surfaced that MSCI, a hugely influential global index provider, was thinking about a monumental rule change. This proposal, released as a consultation document, suggested excluding companies that hold more than 50% of their balance sheets in digital assets, labeling them crypto treasury companies. The primary target, named or not, was obvious to everyone: MicroStrategy. The timing was almost too perfect. Just as the fear and uncertainty from the MSCI news hit the market, JP Morgan entered the scene, not as a neutral party, but as an amplifier. The banking giant published its own bearish reports, highlighting the very risks that the MSCI proposal presented. They warned their clients in the market that MicroStrategy was at risk of exclusion from major equity indices. Suddenly, that seemingly random price drop made a lot more sense to a lot of people. It looked like the result of a perfect storm, a potential delisting that would force billions in automatic selling, amplified by a powerful Wall Street voice, all happening after a pre-existing tightening of leverage that would make it harder for investors to hold on. The immediate aftermath was brutal. MicroStrategy stock, MSTR, plunged. What was once a high-flying darling of the S&P 500, a premier way for institutions to get Bitcoin exposure, was now under severe pressure. The attack, if that's what it was, had drawn first blood. The market was panicked, liquidations were cascading, and the crypto community was pointing its finger squarely at one institution: JP Morgan Chase. To them, this wasn't just a sell-off, this was the beginning of a siege. To really get what's being alleged here, we need to treat this like an investigation. We have to examine the evidence the crypto community has presented, breaking down this supposed attack into three distinct fronts: the margin weapon, the index threat, and the information war. On their own, you could maybe explain each one away as standard financial maneuvering, but together, that's what forms the basis of the accusation that this was a deliberate assault. Front one, the margin weapon and the great squeeze. Let's start with the most direct tactic, the margin call. If you're not familiar, holding a stock on margin means you've borrowed money from your broker to buy it. Your shares are the collateral for that loan. The margin requirement is how much of your own money you need in the account. If the stock's value drops, your collateral is worth less, and the broker can issue a margin call demanding you either deposit more cash or sell shares to pay down the loan. It's an incredibly powerful tool for forcing people to sell. Now, here's the core of the accusation. In November 2025, reports exploded across social media that JP Morgan had dramatically hiked its margin requirements specifically for MicroStrategy. The numbers being thrown around were staggering, with some anecdotal claims from traders of a jump from a standard 50% all the way up to 95%. Let's be clear about what a 95% margin requirement means. It basically makes it impossible to borrow against the stock. It's telling clients, we no longer trust this asset as collateral. For any investor using MSTR in a leveraged strategy, this move is a kill shot. They face a choice. Either come up with a huge amount of cash immediately or be forced to sell their MicroStrategy shares, like it or not. This forced selling creates a vicious downward spiral. As margin called investors sell, the stock price drops. That drop then triggers more margin calls for other investors who are then also forced to sell, pushing the price down even further. It's a self-feeding cycle of destruction. And according to the accusers, JP Morgan lit the fuse. But the allegations go even deeper. Anecdotal reports began surfacing from investors claiming they were being trapped. They alleged that when they tried to transfer their MicroStrategy shares away from JP Morgan to a different broker with better margin rules, their transfers were being delayed or even blocked. If true, that's like locking the fire exits in a burning building, preventing investors from escaping the very liquidation spiral the bank had allegedly started. Now, the counter-argument is that this is just prudent risk management. JP Morgan would say a stock as volatile as MicroStrategy, tied so heavily to Bitcoin, is a huge risk to their loan book. They'd frame it not as an attack, but as a defensive move. They might even point out that other brokers have also adjusted margin on MSTR. But for the crypto world, that explanation rings hollow. The sheer scale of the rumored 95% hike, plus the anecdotal reports of blocked transfers and the very suspicious timing, doesn't feel like risk management. It feels like the weaponization of financial plumbing. They see it as JP Morgan deliberately pulling the rug out from under investors to create chaos and drive the price down. Front 2, the MSCI index threat, a weapon of mass delisting. If the margin call was the close quarters combat, the second front was a long-range strategic bomb, the threat of getting kicked out of major stock indexes. This might sound bureaucratic and boring, but in modern finance, it's an existential threat. Here's why. A huge chunk of the investment world runs on autopilot. Trillions of dollars are in passive funds, like ETFs and mutual funds that don't pick stocks. Their only job is to automatically buy and hold whatever is in a specific index, like the MSCI USA or the NASDAQ 100. MicroStrategy is in these clubs. That membership is incredibly valuable. It means any fund tracking those indexes has to own MSTR stock. This provides a constant, stable base of demand. JP Morgan's own analysts estimated that of MicroStrategy's roughly $59 billion market cap at the time, about $9 billion of it was held by these passive funds. So, what happens if MicroStrategy gets kicked out? Every single one of those funds would be forced to sell their shares. It's not a choice. It's automatic. JP Morgan's analysts put a number on this potential catastrophe. They estimated a removal from just the MSCI index could trigger forced selling of about $2.8 billion. If other indexes followed, that number could balloon to a staggering $8.8 billion. This is the context for the bombshell that MSCI was floating a new rule. The rule seemed almost perfectly tailored to target MicroStrategy, proposing to exclude any company holding over 50% of its assets in crypto. On paper, MSCI called this simple index housekeeping, arguing they needed to clarify if a company dominated by Bitcoin is an operating company or an investment fund. But to the crypto world, this was no routine cleanup. The timing was too perfect, creating a cloud of fear over the stock. And who was there to fan the flames? JP Morgan. The bank's analysts released research notes circulated widely, explicitly warning that MicroStrategy was at risk of being removed from these indexes. They were the ones who broadcast those multi-billion-dollar forced selling figures, effectively putting a price tag on the impending doom. Critics say this is a classic Wall Street tactic. You take a potential risk, you amplify it, you create a fear narrative, and you watch the market panic. The accusation is that JP Morgan wasn't just reporting on the MSCI risk. They were weaponizing it, scaring investors into selling today in anticipation of a forced liquidation tomorrow. Michael Saylor fought back, arguing passionately that MicroStrategy is not a passive fund. He stated, "We're a publicly traded operating company with a $500 million software business and a unique treasury strategy that uses Bitcoin as productive capital." He stressed they're an active business, not just sitting on a pile of coins. But in a market driven by fear, nuance is often the first casualty. The narrative was set, the threat of delisting was out there, and JP Morgan had made sure everyone knew it. Front three, the information war and the specter of the short. The third front was a battle for the narrative itself, an information war. This is where we move from financial mechanics to psychological warfare, complete with bearish reports and the looming shadow of a massive bet against the company. As we covered, JP Morgan used its platform to amplify fears around the MSCI exclusion. But there's more. The crypto community alleges a pattern of behavior designed to maximize negative sentiment. One of the most cited claims is that a bearish document from JP Morgan, which caused panic in late November 2025, was actually dated October 10th. 42 days earlier. The accusation? The bank sat on this negative report, waiting for the perfect moment of weakness to release it for maximum impact. This leads to the most explosive part of the story, the allegation that JP Morgan was heavily shorting MicroStrategy. A short is a bet that a stock's price will go down. If true, then all of the bank's other actions would look like a perfectly integrated strategy to make sure their bet paid off. Rumors of a massive short position held by JP Morgan spread like wildfire, fueled by prominent Bitcoin advocates. But this is where we have to pump the brakes. According to available evidence, this claim is largely based on speculation. A review of official SEC filings shows no direct short position on MSTR stock. So, does that debunk the whole theory? Not so fast. The filings did confirm two other interesting things. First, JP Morgan sold over 772,000 shares of MicroStrategy in the third quarter of 2025. Second, and maybe more importantly, the bank held put options on MSTR valued at around $117 million. A put option is a way to bet on a stock's decline without directly shorting it. So while there's no smoking gun of a direct short, holding over $100 million in puts certainly suggests JP Morgan had a bearish outlook and was positioned to profit if the value dropped. So what we have is a complex picture. We have JP Morgan publicly broadcasting bearish warnings. We have them selling a huge chunk of their holdings. We have them holding at least $117 million in instruments that would profit from a price drop. And all of this is happening while they are allegedly tightening the screws on investors with margin calls. Is it a proven, coordinated attack? The hard evidence for a direct short is weak, but the circumstantial evidence, the convergence of all these actions at the same time, is what has the crypto community convinced. We're connecting the dots between margin calls, index threats, and information warfare in what many are calling a direct financial attack on Bitcoin's biggest corporate champion. If you believe in the mission of crypto and you want to understand the battles being fought against the legacy financial system, make sure you subscribe and hit that notification bell. And if you want to go even deeper, make sure you sign up for my free weekly market update newsletter using the link in the description. Every week, I break down the macro forces shaping Bitcoin, liquidity, the dollar, and where the next big moves are forming. It's the best way to stay ahead of the noise. Plus, I'm currently filming my macro investing and trading classes, and newsletter subscribers will be the very first to get access. As soon as the classes are finished, I'll notify my email list directly with the early offer. So if you want priority access before anyone else, make sure you join the newsletter below. The war for the future of money is already underway. Stay informed, stay sharp, and I'll see you in the next one. Every good investigation needs to answer one question. Why? Why would a giant like JP Morgan allegedly go to such lengths to target a single company? The crypto community points to two powerful motives, one obvious and one far more profound. The first motive, good old-fashioned profit. The simplest explanation is greed. If JP Morgan was positioned with significant put options or other bearish bets, then every negative report they published and every margin call they forced was another push towards a massive payday. It's a cynical but entirely plausible scenario. They saw a vulnerability, a stock leveraged to a volatile asset, a fragile market, a looming regulatory threat, and they built a trade to exploit it, using their influence to make sure that trade paid off. In this view, it was just a cold, calculated financial hit, nothing personal. But for many, that feels incomplete. It doesn't quite capture the intensity of the alleged assault, which leads us to the second, deeper motive. The deeper motive, a war against Bitcoin itself. This is the narrative that really resonates with the Bitcoin community. The belief here is that this was never just about one company's stock. This was an attack on what MicroStrategy represents, the single biggest symbol of corporate America adopting a Bitcoin strategy. Think about it. The entire legacy financial system, with JP Morgan as one of its kings, is built on centralized control of money. Bitcoin is the exact opposite. It's decentralized, finite, and apolitical. It represents a direct threat to the banking model. Michael Saylor isn't just an investor, he's an evangelist, teaching other corporations how to convert their treasuries from fiat currency into Bitcoin. He's leading a corporate revolution against the old system. In this light, MicroStrategy is the lead domino. If Saylor's strategy is seen as a huge success, other corporations will follow. That could mean trillions of dollars moving from the traditional financial system into the Bitcoin ecosystem, a massive loss of power and control for institutions like JP Morgan. So, the attack on MicroStrategy is seen as a strategic necessity. If they can cripple Saylor's company, make an example of it, and associate the Bitcoin strategy with failure and punishment, they can scare off other companies that might be thinking of making the leap. Attack the symbol to kill the idea. And this brings us to the ultimate hypocrisy. While JP Morgan is allegedly leading this charge, what is it doing for itself and its own clients? It's diving headfirst into Bitcoin, the same institution whose CEO, Jamie Dimon, famously called Bitcoin a pet rock, is now a major institutional holder through the new ETFs. It's even creating its own complex products for wealthy clients to get leveraged exposure to Bitcoin. The interpretation is clear. JP Morgan doesn't hate Bitcoin. They hate that you can own Bitcoin without them. They want to be the gatekeepers. They want to destroy direct access proxies like MicroStrategy and force everyone who wants Bitcoin exposure to come through them, through their ETFs and their trading desks, where they can collect their fees and maintain control. This isn't a war against Bitcoin, it's a war for control of Bitcoin, and MicroStrategy is caught in the crossfire. An attack of this perceived scale was never going to go unanswered. The response from Michael Saylor and the crypto community was swift, defiant, and a perfect example of the movement's us versus them spirit. Michael Saylor's defiance. Throughout the whole ordeal, Michael Saylor was the picture of conviction. He didn't shrink, he went on the offensive. Facing the threat of being reclassified as a fund, he took to every platform available to set the record straight, declaring that his company was a dynamic operating entity, not a passive holding company. He projected pure strength. In a message to his followers, he stated, "Our conviction is unbreakable. Our mission hasn't changed. Not now, not ever." He turned a moment of weakness into a test of faith, calling the price drop Satoshi's gift to the faithful, a chance for true believers to buy the dip. For the Bitcoin faithful, it was exactly what they needed to hear. The community strikes back, the boycott. Saylor's defiance lit the match, and the crypto community became the inferno. Outrage coalesced around one simple idea: boycott JP Morgan. The call to action was direct. If you support Bitcoin, pull your money out of the bank that's trying to destroy its biggest champion. The movement gained serious traction. Prominent figures like Max Kaiser threw their weight behind it, calling on followers to crash JP Morgan and buy MicroStrategy and BTC. Then Grant Cardone, a high-profile real estate investor, announced he was pulling $20 million from Chase and preparing legal action. While his lawsuit was reportedly over separate issues, the timing and his public statements lent massive firepower to the boycott. The hashtag #boycott JP Morgan trended, flooded with screenshots from everyday users claiming to be closing their Chase accounts in solidarity. The broader fallout, a market re-rating. While the community response was passionate, the market impact was more complex. The alleged attack certainly fueled immense volatility and triggered a massive liquidation wave. However, it's an oversimplification to blame all of MicroStrategy's stock performance on JP Morgan. A deeper structural shift was also happening. For years, MSTR was one of the only easy ways for institutions to get Bitcoin exposure. With the arrival of spot Bitcoin ETFs, that's no longer true. A great rotation has been underway. Reports confirmed that institutional investors divested a staggering $5.4 billion from MicroStrategy in just the third quarter of 2025, shifting that capital towards direct Bitcoin ETFs. This market evolution helps explain why MSTR's famous premium has evaporated. So while the alleged attack from JP Morgan may have been the catalyst that accelerated the crash, the stock was already facing a fundamental re-rating. JP Morgan is simply accused of turning what could have been a controlled descent into a nosedive, hoping to profit from the wreckage. So, where does that leave us? We have a series of highly suspicious events, all converging on one company at its most vulnerable moment. We have reports of a devastating margin hike, the looming threat of an MSCI index exclusion amplified by JP Morgan's own research, and an information war fueled by bearish reports and at least $117 million in put options held by the bank. On the other side, we have a defiant Michael Saylor, a passionate community launching boycotts, and the undeniable market reality of a great rotation out of proxies and into spot Bitcoin ETFs, a migration JP Morgan itself is profiting from. Was this a coordinated, malicious attack? Or just a series of coincidences and prudent risk management? There's no single smoking gun that proves a conspiracy, but to dismiss the mountain of circumstantial evidence as coincidence feels naive. The timing, the combination of tactics, and the clear financial motive all point to a bank that, at the very least, saw a chance to profit from a company's downfall and used its immense power to help it along. This whole saga is a microcosm of the larger conflict that will define the next decade of finance: the battle between the centralized incumbents and the decentralized challengers. It's a glimpse into the tactics the old guard might use to protect its kingdom, not through debate, but through the very plumbing of the financial system they control. This may have been the first major assault of its kind. It almost certainly won't be the last. The real question is, was this the last gasp of a dying system, or was it the opening salvo in a long war for the future of money? What do you think? Was JP Morgan just managing risk, or was this a coordinated attack? Let me know your theory in the comments below.